The US dollar is falling, fast. It just hit its lowest level in nearly 3 years, and it's not alone. At the same time, bond yields are spiking, investor panic is rising, and the world's biggest money managers are quietly pulling out of US assets. One Wall Street strategist even said, "The US is starting to look like Brazil. Stocks down, bonds down, dollar down, all in the same week." That's not normal for a global superpower. That's a sign of something deeper, a loss of confidence, a system under pressure. And the question everyone's asking right now is, has the US lost control of its financial future? In this video, we'll break down what's really driving the collapse of the dollar, who's benefiting from it, and what it means for the future of the global economy. If you're serious about staying ahead of this shift, make sure to like, subscribe, and turn on notifications. Let's dive in. Just days ago, the US dollar dropped 0.7% against a basket of major currencies, its sharpest single-day decline in recent memory, pushing it dangerously close to a 3-year low. At first glance, it might seem like a routine fluctuation. But in context, it's a signal, one that turns from concerning to alarming when viewed alongside other trends in the US economy. Now, yields on 30-year US Treasury bonds surged to 4.98%, almost 5%, a level that typically signals rising investor anxiety. Bonds are supposed to be the safe haven of global finance. When their yields spike this dramatically, it's not about chasing higher returns. It's about demanding protection from risk. What's driving this fear? The data tells part of the story. The latest US manufacturing PMI fell to 48.5 in May, a clear contraction, since anything below 50 signals decline. Even worse, it's a drop from the previous month, confirming not only weakness, but acceleration in the wrong direction. Now imagine you're a global investor. You see the dollar falling, bond yields rising, and industrial activity fading. Since 2022, you've taken hits in both stocks and bonds. Normally, when equities drop, bonds rise. They balance each other. But not this time. This time, everything is falling at once. A dangerous signal typically seen in emerging markets, not the world's largest economy. And here's where the alarm bells really start ringing. Financial strategist and NYT best-selling author Larry McDonald put it bluntly in a recent interview. This is not temporary. The dollar is in a secular decline. That's the heart of the issue. This isn't a market hiccup. It's a long-term shift. McDonald says investors are losing faith in US bonds as a reliable safe haven. Without that confidence, demand for dollars starts to evaporate. And when dollar demand drops, the entire global financial system begins to wobble. So this isn't just about a falling currency. It's about a deeper structural crack in the foundation of America's financial dominance. But how did we get here? And why elite investors are now comparing the US to economies like Brazil? It's not just an insult, it's a wake-up call. So why is this happening now? What's broken inside the system that used to be the gold standard for global finance? The short answer is, confidence is collapsing. For decades, global investors saw the US as the safest place to store wealth, thanks to stable institutions, steady returns, and the strength of the dollar. In times of crisis, capital rushed into America. But today, the tide has turned. International investors are pulling back, not because they found better options, but because they no longer trust that America is playing by the same rules. Look at the market behavior. Since 2022, investors have lost money in both stocks and bonds, a highly unusual scenario. Normally, bonds rise when stocks fall, cushioning losses. That's the point of diversification. But when both collapse together, it stops being protection. It becomes correlation, and that's dangerous. This rare pattern, stocks down, bonds down, dollar down, isn't typical for a G7 economy. It's something you expect from unstable, heavily indebted emerging markets. Yet here it is, unfolding in the US. Financial strategist Larry McDonald made it clear. The guys in Washington are playing with dynamite. They've created a dynamic where the US looks 5 to 10% more like Brazil. That's not just a dramatic soundbite. It's a reflection of how fast America's reputation for financial stability is unraveling. In emerging markets, when trust evaporates, investors flee, ditching currency, dumping bonds, running to hard assets. We're now seeing early signs of that same behavior. The dollar is falling. Treasury yields are rising, not because growth is strong, but because risk is rising. And when both your stock and bond markets stop acting as stabilizers, your financial system becomes fragile. There's also a deeper shift happening. For years, US assets were synonymous with safety. Now they're becoming a risk to manage. Fund managers are pulling back, not out of preference, but necessity. The old rules no longer apply. Loss of confidence doesn't happen all at once. But once it starts, it can snowball quickly. When investors feel that US policy is unpredictable or politicized, they don't wait around. They move their money. Fast. And that's exactly what's happening now. But where is that capital going? Who's benefiting from America's unraveling credibility? Surprisingly, it's not just traditional safe havens. It's a new set of players rising to the surface. Places like Australia and South Korea. As trust in US assets fades, global investors aren't just watching, they're acting. They're restructuring portfolios, not because they want to, but because they have to. And the message is clear. Reduce dollar exposure fast. We're now seeing a strategic pivot toward assets and currencies that are perceived as more insulated from US instability. The Australian dollar and the South Korean won, once niche plays in the FX market, are becoming increasingly attractive. Why? Because they're tied to economies that are relatively stable, less entangled in global trade tensions, and not burdened with runaway debt. Hard assets are also making a comeback. Gold, silver, platinum, and palladium are all experiencing renewed demand. Not just as inflation hedges, but as stores of value in a system that feels increasingly uncertain. Even Bitcoin is getting attention again, not as a speculative moonshot, but as a digital alternative to traditional fiat risk. According to Morgan Stanley, these shifts aren't temporary. Their analysts now forecast that the US dollar index will fall another 9%, hitting levels not seen since the 2019 global health crisis. JP Morgan remains bearish as well, while Goldman Sachs has gone a step further, warning that the dollar is currently 15% overvalued. That means this isn't just about market noise. This is a structural correction in the making. Goldman's research also highlights something more alarming. Recent US tax changes, especially those targeting foreign passive income like interest and dividends, could further erode global appetite for US bonds. If holding US assets means paying higher taxes and taking on more risk, investors will look elsewhere. And they are. This isn't just about individual institutions making isolated decisions. This is coordinated risk management on a global scale. Sovereign wealth funds, hedge funds, and even pension systems are moving, adjusting exposure to minimize fallout from a potential dollar decline. The shift is already visible in capital flows. Demand for non-dollar assets is rising. And as more investors reposition themselves, they're not just hedging against volatility. They're voting with their money. They're signaling that the era of blind faith in US financial leadership is over. And as the dollar retreats, other currencies are stepping up to fill the vacuum. Some are rising fast, fueled not just by market momentum, but by a global rebalancing of trust. Let's take a closer look. As investors flee the dollar and reposition globally, the bond market is sending an even louder warning. Yields on long-term US Treasuries are rising sharply. Just recently, the 30-year yield climbed to 4.98%, inching toward the psychologically important 5% mark. Now that might sound like a good thing. Higher yield, more return, right? But in the bond world, rising yields mean falling bond prices. And more importantly, they mean something deeper. Investors are demanding more compensation for risk. And that's the red flag. This isn't a vote of confidence in America's growth. It's a signal that markets no longer trust U.S. debt the way they once did. Investors aren't sure whether the government can or will control spending, inflation, or long-term fiscal stability. Even J.P. Morgan CEO Jamie Dimon warned that the U.S. bond market could crack under the weight of rising debt loads. That's not a fringe opinion. That's coming from the head of the largest bank in the country. Meanwhile, Treasury Secretary Scott Bessent is on a PR tour, telling markets, "The United States will never default." Those words were meant to calm the storm, but instead, they highlighted it. Because if you're forced to say it out loud, the concern is already out there. And here's the problem. The more yields rise, the more it costs the U.S. government to service its debt. We're not just talking about higher rates for new borrowing. We're talking about trillions in existing debt that needs to be rolled over at much higher interest levels. It's a feedback loop, and it's accelerating. More debt means higher yields. Higher yields mean even more debt service costs. And each time that cycle repeats, global investors ask the same question: why risk exposure to this system at all? And increasingly, they're answering with their feet. As trust in U.S. bonds erodes, capital isn't just shifting markets, it's reshaping the global currency landscape. With the dollar under pressure, other currencies are beginning to rise, drawing renewed investor interest. On June 2nd, the euro jumped to $1.14, its highest level in over 5 weeks. And that may be just the beginning. Morgan Stanley now forecasts the euro could climb to $1.25 by next year, as European assets become more attractive amid America's fiscal uncertainty. The British pound is also gaining momentum. Currently hovering around $1.35, it's projected to strengthen further to $1.45 if the dollar slide continues. In a market hungry for stability, investors are finding relative confidence in currencies backed by clearer policy direction and less debt-driven risk. Even the Japanese yen, which had been under pressure for much of the year, surged 1% in a single day, reaching almost 142 per dollar. That's a sharp move for a currency that usually trades within narrow bands, and a clear sign that global sentiment is shifting away from the dollar. And it's not just isolated moves. The dollar has weakened against every single one of its G10 peers. That's broad-based pressure. It tells us this isn't about one country outperforming. It's about the world moving away from the U.S. currency system. What these rising currencies have in common is telling. Stable domestic policy, less exposure to U.S.-China trade fallout, and in many cases, stronger current accounts. That's what global capital is chasing now. Not just yield, but credibility. This currency rotation is more than just forex trading. It's a vote. A global referendum on which economies are managing their risks and which are letting politics outweigh long-term financial health. And while capital is shifting toward stronger currencies, it's also responding to something deeper. A growing sense that the system itself is cracking. This isn't just about markets reacting to data. It's about how Washington is shaping that data through policy. And lately, those policies have only added fuel to the fire. The pressure on the dollar isn't just coming from markets. It's being accelerated by Washington itself. Trade tensions between the U.S. and China are heating up again. Both sides are now accusing each other of violating the trade deal signed just weeks ago in Switzerland. And if those talks collapse, we could see a return to tit-for-tat tariffs, the very same policies that rattled global markets during the last trade war. For investors, that's a flashing red light. More instability, more risk, more reasons to diversify away from U.S. assets. But there's more. Hidden inside recent legislation are new tax measures aimed at foreign investors, particularly higher taxes on passive income like interest and dividends. That might sound like a domestic issue, but to global money managers, it's a message. U.S. markets are becoming less friendly, less predictable, and more politically volatile. All of this is pushing investors to rethink something much bigger: the role of the dollar itself. For decades, the U.S. dollar wasn't just a currency. It was the foundation of the global financial system. But when you combine political dysfunction, ballooning debt, and unpredictable trade policy, that foundation begins to crack. The shift we're seeing now isn't just about a weak month or a bad data point. It's about deep, long-term erosion of trust. Investors are no longer asking if they should hedge dollar exposure. They're asking how fast they can do it. And that's what makes this moment historic. Because once reserve currency status is questioned, once diversification becomes not just smart but necessary, it's not easy to reverse. The global financial map is being redrawn. And for the dollar, the next few months may determine whether it remains the center or starts sliding to the margins. The financial world is shifting, and fast. What once seemed unshakable is now under review by the very system it built. Is the US becoming the new emerging market in the eyes of global investors? If you want to stay ahead of this unraveling, hit subscribe, turn on notifications. The next shock may be closer than we think.